After a sticky 3.8% annual rate of inflation figure, an unchanged interest rate from the Bank of England at 4%, albeit after a split decision, and a weakening in the monthly UK consumer confidence reading from the consultants GfK, we get a chance in the coming week to see what three companies think is happening across the UK economy and how Britons are spending their money, or not, as the case may be. And these three companies are Greggs, with a third quarter trading update on Wednesday the 1st of October, Tesco, which has got first half results on the 2nd, and JD Wetherspoon, which will release full year figures on Friday the 3rd. Now, all three provide us with staple, basic needs one way or another, and all must balance input costs, staff, utilities, raw materials, ingredients, against pricing to protect margins, but do so without jeopardising volume, and thus provide that concept of value to their customers in what remain highly competitive markets for takeaway food, groceries, and eating, drinking, and dining out. Shares in Greggs have rolled over and lost around half of their value in the past year, scorched by July's profit warning. Chief Executive Roisin Currie attributed that setback to hot weather, weak high street footfall, and phasing of increased costs, as the company built a new national distribution centre in Kettering, and it also continued to add to its store estate. Questions as to whether Greggs has expanded too far too fast, made its menu too complicated, have also added to wider worries over the state of the UK economy. In this update for the 3 months to the end of September, watch out for comments on total sales, up 7% at the first half stage, but also the like-for-like trends. Any details on pricing, volumes and costs? Greggs has previously stated that input costs would rise around 6% this year, thanks in part to those higher national insurance contributions. Net store openings, which are due to reach 140 to 150 this year, as part of a wider drive to take the total store estate to 3,000. And above all, any comment on profits, where Roisin Currie has cut forecasts for full-year operating profit to a small decline in 2025, and that compared to her previous estimates of progress. The analyst consensus, by the way, is looking for 188 million for the year as a whole, down 4% from 2024's total. Now, in marked contrast to Greggs, shares in Tesco have roared to their highest mark since 2010. They've been helped by the woes of Morrisons and Asda, which are struggling under the debt burdens shoveled onto them by their private equity buyers. Tesco has picked up a precious 0.8 of 1 point of market share over the past year, according to Kantar World Panel. Those gains helped Tesco to rack up double-digit percentage gains in both adjusted earnings per share and dividend per share in the last fiscal year, and the grocery giant maintained its strong momentum in the first 3 months of this year to February 2026. June's trading update revealed 4.7% like-for-like sales growth in the UK in the first quarter and 4.6% across the whole group. Analysts will look for the second quarter trend here. After that, attention will turn to operating profit, where Chief Executive Ken Murphy has offered guidance for the year of a range of between £2.7 and £3 billion. That's down a bit from last year's £3.1 billion, and analysts have thus far cited concerns about a grocery price war as a reason for that caution. A year ago, Tesco's first half adjusted profit was £1.65 billion, including £1.55 billion from groceries and just £100 million from the subsequently sold bank. Mr Murphy's maintained the target of generating between £1.4 and £1.8 billion a year in free cash flow, and that helps to fund returns to shareholders. Tesco's running a £1.5 billion share buyback, and consensus estimates suggest the grocery giant will raise its full-year dividend to 14.2p a share from 13.7p. So it seems logical to expect an increase in the interim distribution. The first half payment a year ago, by the way of a benchmark, was 4.25p a share. Now, JD Wetherspoon's shares are actually broadly flat over the past year, even though the pubs group, with an estate of around 800 sites, is expected to report record sales for its financial year to July 2025. The issue, therefore, is one of profit, where increased wages and utility bills are having an impact. Chair Tim Martin has quantified the effect of last year's increase in national insurance contributions at £60 million, or around £1,500 per pub per week. He also continues to rail against VAT and business rates, or at least the different treatment applied to pubs and supermarkets. July's trading statement saw Mr Martin note that full-year results will be in line with expectations, where analysts are currently looking for sales of just over £2.1 billion and pre-tax income of £80 million compared to £2 billion and £61 million a year ago. Should Wetherspoons offer any guidance for the year ahead, well, the current consensus analyst is looking for an increase in pre-tax profit to £84 million, but that would still be below the pre-pandemic high, even though sales are expected to be around £400 million higher than in 2019. Note that the company returned to the dividend list in 2024 after 4 blank years, and it's also started a share buyback programme. Analysts expect a final dividend of 8p a share to take the total to 12p, the same as last year. Thank you for watching. Hope that you and your families are all keeping well, and I look forward to seeing you again next time.